Keith Neumeyer was talking about the current economic situation and the future of gold and silver. Keith said that the US market is the key market on the planet and it's been on fire for the last couple of years, but it's now rolling over. We are likely going to see a fairly large decline in the stock market sometime later this year. That could bring all stocks down, even the mining stocks. But if you go back and look at what happened in 2002 to 3 and also in 2008 to 9, the first sectors that moved were the mining sector. They have over the decades always proven to be the place to keep your wealth intact. To be an investor, you have to trade these stocks. You are up 300-400% or 500% on a stock. You should be selling half of it and waiting for that decline because the mining sector is cyclical. The stock market is cyclical. You need to have a 10-year view on investing in resource stocks because that's how long these bull markets last. This bull market started, let's call it January of 2016. Going out 10 years from that point, you are in 2025. That's kind of the time frame that you should be looking at. So you shouldn't be looking at this time to be liquidating. You should be looking at opportunities to be buying. You should look at this as more of a longer term cycle than just a trade. You should compare this to 2000 to 2001, and that's the kind of market we are going into. That's when the miners and the metals just exploded and we saw silver go from $5 to $50. We saw gold from 250 to 1800. We saw copper go from 60 cents to $4. We saw uranium move up to 140. We saw oil go up 140. And we saw real estate prices really took off. There was this huge inflation trade in the market. The big institutions, the big money out there realized, hey, we have been buying crap. All that we have been buying is business plans without any backing, like specs for an example. So they just got tired of it and then they blew all this stuff out, driving them as that gap by 80%, and all that money flowed into real assets like real estate, oil, copper, silver, or gold and mining stocks and so on. Now Keith says that we are halfway into this and we have got long ways to go yet, so that there's nothing different between the bear market from 97, but the bull market started in 2002 and it lasted until 2012, which is a time frame of 10 years. But over that 10-year period, there were several times over that 10-year period that the executives in the mining sector thought the full market was over, but it was not. It was corrected for 6 months and sometimes gut-wrenching corrections and then took off again. That's the kind of thing that we are into right now. We are just in a short-term correction in a much larger bull market. Keith warns that investors who invest in this space, this is a very risky, very cyclical, very volatile space, and you never know when the bull market is going to act. Despite the view that it's going to be a 10-year long bull market, it could be wrong also. So in that case, you have to take advantage of movements. If you buy a 50-cent stock, the next thing, it's $3. And then when it does, you just have to be disciplined. You sell part of your position despite your views. You may think the stocks are going to go to $10, but you have to be prudent. Take your money off the table. Even take a little bit of profit off the table. Take your position down by 50 or 75% and wait for that correction. If it doesn't correct and the stock keeps going and you sell your balance at some other higher price, so be it. You have made a lot of money and then go on to the next company. Now an important point, just don't fall in love with your investments, and always when you buy, pick your price that you are willing to pay for it. Also, as you are buying, visualize the price that you want to sell it at. A lot of people don't do that. If you do that and remain disciplined, you will find that you do quite well over time because most people are not good sellers. Selling is the hardest thing to do. We are not trained to sell, we are only trained to buy. Here we have credit cards quite young, where we like having toys. So we are always looking to buy things. When we turn around, sell something, we often just give it away. But we don't have the energy to sell it. So you don't expect to get much from things that you buy. so you are not programmed that way. But the only reason why you invest is to make a profit, and that's why we are in the software. Make profit, we are not charity. We are not giving money away to people. We want to make profit. So to make that, rules and discipline, you have to follow them. Now Keith says that silver is a very tiny market. Some of these other metals like copper, that's a pretty big market. When we think there were about 750 million ounces of silver produced in 2020 worldwide, that's down now 4 consecutive years for a peak of 880 billion ounces that was hit in or reached in 2015. So for 4 consecutive years it declines and demand is increasing and that falls off going backwards. So we are getting tighter and tighter and tighter in this very tiny market. Less than what's 800 million times 25 bucks, $23 billion market. How many times can that market fit into Apple? So it doesn't take much to move a market like silver. Unfortunately, it's very paper driven and there's a lot of derivatives out there. And that's what this whole Reddit movement is all about buying physical. It may not be the industrial demand that drives the price $200 an hour. It actually may be the retail demand that just understands the importance of this metal. It is such a strategic metal as necessary for everything that we do as the human race. People just want to own it. The banks can manage the market like they know the supply that's coming. The people that sell our metal have a pretty good idea of what we are going to produce in 2021. Keith says that we put out guidance in January and we update our guidance in July, and the entire mining sector does the same thing. So the banks kind of know what's coming in the door. So if Sony phones up and says that they need 50 million ounces of silver delivered at these variety of ports around the world for the production of their products, JP Morgan or HSBC know how to price it. So they'll give them a 12-month price. So they are taking a short position on that trade. And of course, Sony is expecting the delivery of this metal over the next 12 months, which means it's now in the best interest of the banks to keep the market within a fairly tight range because they don't want that trade to cost them very much. So they have got a pretty good handle on the supply-demand fundamentals of these metals. So guys, I would like to know your thoughts in the comment section below. Also, if you found this video really informative, then please make sure to convert that like button into blue. Subscribe to our channel. I'll see you in my next video. Till then, have a great day.